And Dr.G.Anandhi, Department of Commerce and Economic. I have handled the subject, the investment management. I have explained the security analysis. Security means is the near shares, how to the shares buying and selling to the market to analyze for the chapter. So first one is a fundamental of analysis. The examination of future earning potential of the company is called a fundamentals of analysis. Analysis of the economic well-being of financial entity as opposed to only its price movement. Analyze the various factor impact of performance of the company. It considered economic and financial other qualitative and quantitative of the factors. To analyze the fundamental financial of the security, you have to buy and selling to the market. Was the rate and was the rate increase or decrease to analyze into the market? That is the fundamentals of analysis. Objective valuation of stock is comparison to its current price. I have to buy it today. I have to buy the shares value is 10 rupees. Was the rate of the nature on next hours or next day morning is an 11 rupees or 9 rupees? The comparison between your current price. It is an increase or decrease. The decision to buy or sell a stock on the basis of the valuation in the market. 100 price of the shares, you have to buy easily to buy the shares. Over price of the shares, you have to immediately sell to the shares into the market. You have to buy any shares in the 10 rupees, but at that time you have to sold to 12 rupees. Immediately sell to the market. Under price is you have to for that present time you have to buy the 10 rupees share. That shares sold in the market is in a 9 rupees. You have to easily to buy the shares immediately. That is the fundamentals of analysis. Various tools of fundamentals of analysis. First one is earning per share. Earning per share is the portion of the company's profit allocated towards each outstanding share. That is for earning per share equal to net income minus dividend on preferred stock divided by average outstanding shares. You have to get your profit, net profit minus the dividend on means out of the profit amount allocated to dividend, the divided by average outstanding get an earning per share value. Price earning ratio equal to the valuation of ratio of a company current share price compared to its per share earning is market value per share divided by market per share value is earning per share value. So earning per share means first you have to find out the earning per share, net income minus dividend on preferred stock divided by average outstanding. Then second, pricing of a earning share equal to market value per share divided by earning. So first you have to find out the earning per share, then you have to easily to find out the price earning shares. Then a dividend payout ratio is measure the percentage of company net income that is given to shareholders. Then out of profit distributed to shareholders, that is called dividend. How to calculate dividend? Total amount of dividend per share divided by diluted earning per share. Earning per share equal to net income minus dividend by preferred stock divided by average outstanding. First, you have to find out earning per share and price earning per share, then dividend payout ratio. The dividend discount model is the present value of all the future cash flow in the form of dividend plus the present value of the sell price expected. That is, dividend is equal to price present value of the cash flow equal to D1 plus 1 plus R P1 divided by 1 plus R. P equal to the current price D1 a dividend expected at the end of the year, or is a discount rate P1 and a market price or expected price at the end of the year. That is a dividend discount model. That is a constant growth model. Is presume the dividend per share is growing constant rate. Is in a particular period you have to constantly increase, sometimes constantly decrease. So how to calculate for a constant growth rate equal to P equal to D1 divided by R minus D. D1 a dividend per share at the end of the first year or equal to expected rate of return T equal to constant growth rate. The constant growth rate is increasing of a value, decreasing of a value easily to find out from your fundamental of an analysis. Economic analysis is important to analyze the economic activity in which all the companies operate. For economic analysis, we can see the few economic indicators, global economic, domestic economic, the top-down analysis. Companies start with a global and domestic companies. An economic analysis is a different way profit and loss. That is a find out and develop or underdevelop. That is an economic analysis. Then in a domestic economy, GDP is an employment, inflation, and interest rate, budget deficit, and other factors. Money supply, fiscal supply policy, and FDI investment is a domestic economy. Is a industry analysis. So the industry analysis is the second phase of fundamental analysis. So first one is a fundamental analysis to find out the value of the shares, earning per share, pricing per share, and dividend per share, payout of the ratio. Second one is a fundamental analysis. Second one is an industry analysis. Industry selected in the previous stage as scanned individually. Is a micro study of each industry is carried out. Objective is to provide information about the best industry at the investment. Which one is a best industry? How to select it easily to investment the money to that. That is an industry analysis. Step taken to for any industry analysis means to study at the industry life cycle. How to invest, how to develop, how to circulate to that industries. Study of qualitative and quantitative of factors of the industries analysis. And the step taken of industry analysis. One is the industry life cycle. Is an pioneering stage and a rapid growth stage and maturity and stabilization stage and a decline or diversification stage. Second one is qualitative and quantitative factor, qualitative factor and quantitative factor. That is both of the included in the industry analysis. Was a drawback of the fundamentals of analysis. They rely on historical data. So so many years of the maintained for on records. That is historical data. Poor predictors how the share price react to on economic and industry level changes. Provide estimated and expected return. Don't offer measures to the variability of returns and don't reflect the underlying the risk review and the relationship is a drawback of fundamental analysis. And the comparison between fundamental and the technical analysis. Fundamental of an analysis. It start with the study of financial statement. Technical analysis start with the security from the charts. Financial analysis attempt to measure the company intrinsic value. Technical trader believe there is no reason to analyze the company's fundamental. There is a long-term approach is a historical data is taken under a consideration, but a technical is a stock price, a short-term data. Short-term data consider the analysis of the stock. So fundamental of analysis is a stored financial statement is stored with a security. Financial statement is attempted to intrinsic value. Intrinsic value is a asset minus abed. Technical trader is a fundamentals allowed for a stock's price. Is a long-term approach. The technical analysis is a short-term approach. Fundamental analysis used to make an investment. Technical analysis used for a trade. The technical tools is the Dow theory, moving average and odd loading trading and the rate of changes and chart the chart pattern, efficient market hypothesis and random walk theory. And the Dow theory, the Dow Jones proposed for this day to explain the movement of its series. Three hypotheses that are developed by no single individual or buyer can influence the major trends of the market. Market discount the everything. The theory is infallible. Is the Dow theory, the Dow Jones is an explain to the movement of hypothesis that is accepted or not accepted to analyze for the analyze for only fundamental analysis and industry analysis is satisfied or not satisfied is accepted for only the accepted for this hypothesis and not accepted for this hypothesis less than 0 and more than 0. Is easy to find out for on industry analysis. Trend is the direction of the movement of the shares can either increase or fall or range of the plate. There are the three direct raising, falling and flat trends. Raising means of an increasing, falling means it's a decreasing, flat trend is there is no increase, there is no is in a constant line of the pricing. That is in a three types. That is the trend may be either increase and decrease in the market trend exhibiting increasing, it is in a bull market. Is in a three clear cut peaks. The peak higher than the previous peak. Bull means is in a there is no enter into a new enterprises. The reason bull is easily to throw out to the market. So the bull character is no enter into a new enterprise into the share market. Is an already existing company is a run to the top of the he has to bull broker is a maintained for on status to fund industries. Revival of a market here, more and more investors are engaged by the expectation about the future. I expect today I have to buy the 10 rupees. Today I have the expectation for only 12 rupees. That is in your future expectation of on your future high. Earning pay. In this phase is the increased profit of corporate would result in the further price issue. Further price earning per share is an increase. Every one investor is the expectation is more than the face value. It's get an earning of the shares value. Speculation space when prices advances due to the inflation and speculators. On the BIHER market is a BIHER market is called one of the speculator. There is a loose of the chances of pricing move high level is low. This speculator first one increasing of on a rate to wait for the data market. Then thereafter the BIHER broker is then it suddenly fall down the market. The investor to suffer that there is a new investor not only easily to enter that is one of the tricks followed by a BIHER market speculator. That is one of the loose of rope. There is a recession in your business. A company will reporting lower profit and dividend. Is a distress selling is sold below at par value. There is a BIHER market. Secondary trend is an intermediate trend which moves against the main trend and leads to the correction. Bull market result is in a fall. BIHER market result is in a upward. The bull market is in a weighted. First, they startingly increase the rate of the shares. Thereafter, is the decreasing of the shares into the market. But here, the starting later increasing the rate because not easily to enter into the newcomers, new competitor not easily to enter into the market. That is a bull and bear. Is a minor trend. The price fluctuates daily. That is fluctuation means increase or decrease. The minor trend try to correct the secondary trend movement. The investor to concentrate on primary and secondary market. Primary means is a new issue market. Secondary is an already existing shares or sell to the market. There is a secondary market. The primary market is a new the new is a followed on procedures with issue the application, collecting the application and allocate the allotment of the shares and rejected of the shares. Refund of the shares to the investor. There is a primary. Secondary is an underwriter. Underwriter means is a for startingly expectation to buy the shares, but not buy the share. For that time, underwriter to sell the shares. They get a commission of an underwriting commission. That is a secondary trend. That is a chart pattern. Chart of the valuable and the easiest tools of the technical analysis. The graphic representation of the data helps the investor to find out the trend of the price. What the current trend are buying and selling. They show the past historical movement. There is a chart. The chart means is the graphic representation. The data is any for comparison between the last year. There is a present year comparison, a past year or past 5 years comparison between a chart diagram, histogram. The chart between differentiate between the shares the fluctuation prices. That is a historical movement. To predict the extent and direction of the price, there is no indication of the time and value. It is the one dimension. The price changes in relation to the previous prices. The price will be marketed as an X. The decline price regarded is as 0. Oh, that is a new. The X-axis and Y-axis, the middle of the center is a Y-axis. That is a direction of the price. If all the prices increase is a market as an X, the price is a decline, that is a decay, that is a below stage, that is a recorded as a O. Then limitation of the trend. That is a intraday price movement is not shown. The whole number of taken into the consideration, there is a loss of the information. The volume is not mentioned in the chart. The chart is not a comparison between the current year to the the last year, there is an increase, there is no growth or the under growth. There is no rate, is not a dimension for that and a chart. There is a development or underdeveloped, that is only chart to the flow way. That is a way of increase or decrease, the chart only to prefer for that. Then in a bar chart, the bar chart is simple. Bar diagram is a simplest and most common to technical analysis, easy to compare with the current year and previous year. The dot is enter, it represents the highest price, the stock traded. Another dot indicates the lower price. This is that is easiest of on a bar chart. That is an increasing on the increasing rate. You have to maintain your one dot. Here decreasing for a particular lower price at that a particular date. And the line round they connect both the point. The connectivity increase and connecting to the both the point. A line chart is a simplification of on a bar chart. Then portfolio management is the process of creation and maintenance of investment portfolio. Portfolio management is a complex process which tries to make my investment activity more rewarding and less risky. There is a portfolio management is a decision maker to the maintenance of investment, to take a decision of the investment, to buy, announce, to collect the money from on your public on the shape of share. There is a portfolio management. Major task involved with the portfolio management, taking a decision about the investment risk and the policy, matching investment to objectives, asset allocation for individual and the institutions, balancing risk against the performance is a major task involved with the portfolio management. Like matching the investment to objectives means is you have to compare with a bar diagram or histogram diagram. You have to increase the fluctuations one point to connect it to on another point. The reason a major task is the balance against upon performance. The basis of on portfolio management means the portfolio management is a process of many activities. That is a security analysis, portfolio analysis, portfolio selection, portfolio revision, and portfolio evaluation. So for then many process you have to follow for a portfolio management. Security analysis. Security analysis the initial phase of the portfolio management. There are many types of securities available in the market, including equity shares, we have a preference share, debentures, and bonds. In the form of initial phase of portfolio management process, portfolio management is invite money from on your public on the shape of share. Share is divided into two. One is an equity, another one is a preference share. On the another type is a debenture. Another one is a bonds also. So management process involves the evaluation and analysis of the risk return features of individual security. The basic approach of investing security is sell the overpriced security and purchase under the price securities. Overpriced security is more than the face value. Underpriced security is less than of the face value. The security analysis the comparisons upon fundamental analysis and technical analysis. Fundamental analysis is a financial technical analysis is a short term, is a fundamental is a long term. That is a security analysis. Portfolio analysis is a user and organization relation to the environment. The set, collection, assortment, the range of the group. The portfolio may be any collection of brands that the division generating the assets. They usually apply to the firm with their multiple, more than the one product service, customer category, market of divisions. So one product of the service, customer category. So many customer is there. The customer is not, it is a preference and is differ from one customer to another customer. And also interest to invest the investment to one shares to one differ from one shareholder to another shareholder. One shareholder invest on A company, another shareholder invest on B company. Not compromise to one A company is not satisfied with that. So the reason more than one product, service, and the customer categories of one portfolio analysis. So portfolio analysis helps in taking the decision. Security to allocate the more or less resources, strategic the strategic point of time to have a balance balanced portfolio, minimize the risk and maximize the return to all the portfolio. They actively deploy the retrenchment of on your strategy. The reason your firm makes a firm the strategic. The reason decreasing of the rate, you have to buy in your more shares, increasing of the time at the time you have to sell up the shares into the market. The reason time based in your portfolio, minimize the risk and maximize the return. Usually give on invest in a less amount, you return for on your more amount. The reason your strategy. There are portfolio selection during this phase, portfolio selected on the basis of input from on your previous portfolio analyze. The targeted portfolio selection is on your highest return and your given risk, a low risk and the return from your high income. The portfolio valid good returns, portfolio formed in the form of set up an effective optimum portfolio determined the objective and the disciplined conceptual framework for Markowitz and your portfolio theory is and followed on your procedure. You have to maintain your records. Given your prospectus and how many shares are issued to the market for notice to issued on a magazines or an advertising in the newspapers. Is that during the shares transaction during only for any business hours. To how many shares are allocated to one particular investor to maintain for on your record. The selection of on your amount investor to a short period or long period. That is and your portfolio selections. Markowitz and a movement, the most of the people they're holding two stocks are less risky than the holding the one stock. So most of the investor like the less risk and higher the return the investment. That is the expectation of the shareholders. They think that it would be better to invest in one stock. Is it difficult to build the optimum portfolio? Is most of the thing two stock is the less risky than one stock. Yes, to not the investor not ready to invest to the amount to highly risky because expectation is and return amount is the more than the face values. There is not the interest to take on highly risk. This is Markowitz portfolio theory is in 5 assumptions. Single assets of portfolio of the asset is considered to be an efficient. Other assets of portfolio assets of a high expected return with the same risk or lower risk, the same expected return. There is a 5 assumptions. First one is one of the single assets is an efficient or on your portfolio asset is an less risk and the return is more. There is a same is an expected return the same. Other investment amount also return also is both of the same. Is a lower risk return expected rate of return is higher. There is an assumption. There is an assumption of Markowitz of portfolio. So Markowitz of portfolio is assumption is low risk, higher return of income. That is no the interest, the assets of high expected return of investment. Alternative measurement. Variance or standard deviation expected return, range of return expectation. Semi-variation means they are free fixed or free variable. The measure can only consider a deviation below the mean. These measures of risky implicitly assume the investor want to minimize the damage from the return less than the same target issue. Is if you have to same amount return to that in your future also same return from a same amount or a highly return, the measurement is implicit as in the investor minimize the damages, not would like to the less than the investing money. That will minimize the risk. That is an alternative method. Expected rate of return. So individual assets, some of the potential return, multiply with the corresponding profitability of the return. So expected rate of return means it's a number of shares is that some potential returns applied, that the weighted average of expected return individual investment in the portfolio. Then a passive management. Passive management refers to the investor attempt to construct the portfolio as an overall market return. The simpler form of the passive management holding the index fund designed with the replicated goods and common sets such as the BSE Sensex of NSE Nifty. The reason BSE and NSE is 24 hours in the monitoring to the market because second by second is status is differ from one market. So anytime you newly competitor or you're newly introducing in the shares in the market, the competitor, the bull and bear speculator is in watching for only every time. Is a bull and bear is a no enter the new investor to the market. There is easily to throw out the market. Is a bull is any expectation of an startingly increasing rate of the shares, thereafter reducing that shares value. Bullies, there is not any easy to enter new investor in the market. Is easily throw out of the ground. There is a passive active management. Active management holding security means is based on the focus. Focus means in your future. So manager who pursues active strategy is for market components called on market time. The market managers may introduce group rotations. The managers are how to do group of the team. It's a group rotation means changing the investment in different industries, stocks, depending of assess expectation regarding the future performance. So active management is holding security based on the future. So what in the future you have to priorly plan into the do the activities as well as the expectation is in your future. I have the expectation is in a 10 rupees shares current value, the expectation is in a 15. So that is a future expectation. That is an active management. Then portfolio evaluation. These spaces involve the regular analysis and assessment of your portfolio performance in terms of the risk, the return measures, and their quantitatively along with the performance of the portfolio. Compare with the objective norms. The procedures assist identify weakness in the management process, and you have to maintain in the market. So stock it will get the permit. If you have introduced in the market, sales to the market, first get a register upon your stock exchange. So first your company register into the stock exchange is a date as I mentioned, was the company stated balance sheet attached to the registration application forms. Then you have to maintain a category wise, is an alphabetical order and the numerical order arranged for the company status. Which one is somewhere top of the company, which one is somewhere second place. So investor seeing of on NSE and the BSE into the market, the scrolling of the company name is scrolling at the time of selling of the shares. So investor would like to invest in the highest of the which one is the top of the company is to invest. The speculator and brokers also canvassing to the investor. Is an underwriter also sometimes some investor expectation to buy the shares into the future. You have to reserve them some shares. That time that shareholders not buy that particular shares. The underwriter undertake to that share, get a commission from one companies. That is an underwriting commissions. That is a 5% of the shares value or 10% of the shares value. And the debentures also issued in the market. Bankers also intermediate of one stock. Bankers collect the money from one investor, collect the money and give the one certification to one investor. So investor name, how many number of shares to buy in the market, was the market share value, was that at the time of share value, who is the shareholder to sign it to the shareholder issue to the investor to collect the money to invest on a company. That is the duty of a banker. Bankers to charge for some commission to a concern. There is a speculator and land that there is no movement. There is land that a speculator is in, there is no movement. The shares value is increase or share value is decrease. There is no take a decision. That is an lazy speculator. There is no expectation about from that shares value. There is no reaction about the shares in the market value. So he is an increase of decrease. There is no take on the decision. But bull and bear is an bull and bear. That is any time you monitor it for the market is a new market 24 hours watching the market, because the NSE and the BSE is changing to the second by second. So a company is today is a top one company, next day is a 10th place already below the company, because the share market is not a constant. Sometimes increase, sometimes decrease, or sometimes the loss of the company. For that time you have to decline to the shares value. So the stock speculation is a very fast movement, easily to sell to the investor. Fast movement, that is a premium hunting. That is called a premium hunting because that company shares very demanded. Is a premium hunting is a very fast movement of the shares. That is called a premium stock speculator. That is the stock speculator is demanded upon shares to the market for the particular shares of the companies, because that company is anytime your profitable company, continuous profit of the company into the market, for that time shares value is increased. That is stock is then a fast movement to sell the shares to get a high rate to the market. That is a speculator. So speculator is a four type. One is a bull, bear, and stag and lambda. Lambda is there is no. There is an expected of the rate of return is an first you have to charging upon how much of an investment if you want. You have to divide it into small unit. Large amount, one part of the amount invested in the company shareholder, another part is invested invited from a public. Is a public, is a small unit, is a charge for a small amount, because easily to invest the money to in public, because a large amount not like to invest to public to the company. Small amount is so many interested to buy the shares in the particular company. So new investor, some investor having a money but not interested to invest the money because they don't know the company which one is the best, which one shares is a high rate in the market, that they don't go. For that time, he is a broker, intermediate, that is a merchant banker, help to the investor. So new investor to contact to a merchant banker, he has to buy shares to the investor, shares to the investor. So merchant banker to collect the money from an investor to convert into the company status. So company says he used to buy the shares in the market to collect the money to deposit in the bankers. So merchant bankers also help to the investor. SEBI is one of the important stock exchange board of India. Is introduced in the 1965. Is any one company issue the shares into the market, he has to register to SEBI. Is in Mumbai is a headquarters. If you have to register the Companies Act 1956, you have to if you want the shares is after 1 year formation of the company starting, after 1 year invited the public shares from public, you have to get a permission from SEBI Act. There is no easily to follow the procedure, because you have to apply the permission from SEBI formation. You check the incorporate date and formation date and the starting date, and then you have to analyzing. So more than the 1 year, you have to analyzing the balance sheet. It's the analyze the balance sheet. Your assets value is increased. For that time, you give a permit of 1 year. Sell the shares to invite for money of public from investor. So the SEBI is a continuous regulate model, ready to market, continuous market, ready to sell of shares to the market. Is a continuous market means once you have to register to that company, your shares are easily to sell to the investors. It's a continuous mean there is no non-stop. Every day you have to monitoring of companies, because the company board of directors not at all easily to monitor every time. But the speculator or brokers is every time to watch the market, because they got this is a competitive world. Is a day by day new competitor enters the market. For that time, your share market decline easily to decline it to the market. So the broker help to the particular company, that is the goodwill of the company or reputation of the company is standardized in the standardized in the market. Is the scrolling of market share value is a differ from time to time or second to second. There is a rate corresponding profitability of the return, the individual investment of the portfolio management, the weighted the portfolio management is the expected rate of return. The investor expected a return really low risk, high return of the income. That is one of the expectation of investor. I invested 10 rupees was the expectation return of the income. That is a 12 rupees. That is a expectation low risk, high return of the income. The reason also if you have company is down for that an alternative you have to select it. The reason fixed, semi or variable. Fixed is constant. Semi is fixed plus variable. Is constant means there is no changes. Variable means is change. So semi variable considered is the deviation of mean is damage would have written less than the some target rate. I have to fix a target. Everyone you have to select it of future. The reason your forecasting, you have to plan for on your forecasting. Forecasting means in your future. Is an investor deciding about on your forecasting. I have to give on a low risk expectation for on your more income. The reason your investor is in your that is in your financial analysis. So security analysis is in your valuation of on your shares, analysis the comparison between your current year to previous year. You have to do on your board diagram, the histogram chart is in a comparison between the chart pattern. Chart pattern is in a comparison with your law for previous 10 years or current year is in a for current year result comparison to on your current result to equals to on your future result, because there is a chart pattern also included. So technical issue is the near long term. Is a financial statement is a long term. Is the industry is a short term. Technical is a short term measurement. Long term is a capital formation. Capital is a long term. Is a once invested, but the expectation of on your earning is more than the long term. That is a financial statement. There is an increasing of on a profit and loss and balance sheet also increase. The reason your financial is technical is for a short period. There is no expectation. There is no high risk. There is a financial statement analysis is highly risky because is a long term. So the investor is not easily to invest to investment. There is a highly risk, but technical is a low risk comparison between the financial analysis. So security analysis is the expected rate of to find out the earning per share and the expected rate of return and payout ratio of return, then pricing per share. So you have to analyze the security, then issue to public to the investor. So these are the so many tools to use to find out the shares value. So the shares value is not an easily to invest. That is find out the market value and share market value and face value is a premium value or discount value. You have to find out for a security analysis. Thank